Hey everybody, it's Pete. Welcome back to Stocks for Breakfast. It is Friday morning, April 24th, 2020. What a ride we had in the market yesterday. We had some midday news that caused essentially what you would say a crash in the middle of the day where everybody was saying what just happened. It was Gilead, by the way, GILD. We'll take a look at it. The week, as far as a tape reading lesson, the entire week was actually perfect. We had some unbelievable good numbers to trade off of. And again, if you're not familiar with the term tape reading, it essentially means that you're looking at a price and whether or not stock is moving closer to or further away from that price. Now, good tape readers do that before they get into a trade. Excuse me. And the reason they do it before they get into a trade is they set up probabilities, which is why I'm so adamant that we want to move away from calling yourself a chart reader, which is somebody who's looking at patterns and looking at indicators and all of those kind of things, and feeling like you've accomplished something by reading thousands and thousands of charts and dozens of books or videos or something like we're doing now, and feeling like you're moving closer. That's not how you make money. You make money by actually trading, which that could be a whole other video. My thoughts on trading a simulator versus actually trading. I can't stand simulators. Simulators are good for learning a software. You will never learn how to trade on a simulator because there's no emotions involved. And I'm doing this so long now, nobody in the world will be able to convince me of otherwise because there are no emotions. I can tell you 100% of the people who make money on a simulator will not take those same results and put them into the market. No way. Not anybody who's actively trading. Don't tell me you made one trade in April and that's because you got it on a simulator. I'm talking about somebody who's in the market trying to get paid on a regular monthly basis. Anything you do on a simulator will do nothing for you in the real world other than learning how to set up the software and maybe trying to validate your strategy using backtesting. But that's not going to translate because as soon as you put on those trades and even 100 shares, everything changes because now it's, I need to book it, I'm scared. I need to book it, I'm scared. Real trading, paying attention to what works, making a big list of what doesn't work, and then having the guts to say, I believe in my strategy and I'm going to follow it flawlessly with real money. That's how you move from chart reader to tape reader to trader who gets paid. So getting back to what I said before, oh, actually I have a quick question. Not a question. A lot of people are either emailing me or commenting either here or on social media. I call out a lot of ideas for day trading. And I'm getting questions about swing trading the strategy that we're talking about every day, which if you're new to the channel, it's order flow. I trade order flow. It's developed from the New York method, which is how I developed it over the years when I had my trading firm in New York City. I want to make this clear. And if anybody's interested in learning about the coaching program or swing trading or anything like that, I'll post a link at the bottom. All of my ideas, all of my best ideas that I day trade, I would swing trade. So in other words, all of my ideas come from the higher time frames, and then I go down to shorter time frames if I choose to want to day trade those stocks or hold them for a couple of days. The best trades are the ones that I like on the higher time frame. So in other words, they are swing trading ideas first. Then I could alter my entries in the direction of those higher time frames. There's not even a question that the bigger money is in the bigger swing. So why wouldn't you want to know where the bigger money, the smart money is pushing stocks around? So again, I don't know you, I don't know your background, your history, your experience, your trading goals, your risk tolerance, any of that. But you can take this to the bank. The big money's in the big swing. And when you have patience and the tape reading ability to put the pieces together to say, wow, buyers are really in charge of this right now. I'm going to find a spot to get involved, a spot that I could manage my risk and a spot where there's profit potential. And interestingly, we actually have we're going to review 3 stocks today from somebody from the community who's new to the channel. His name is Mike B. So Mike, if you're tuning in today, I'll actually reply to your email. We're going to analyze your analysis of the 3 stocks that you went over. So thank you for sending in the email. So anyway, I want to recap what I just said. Pick a side, then pick a spot. And generally speaking, the big money is in the big swing. I shouldn't even say generally speaking, there's not even a doubt. Can you catch the short-term blips back and forth? If you're disciplined, if you have a strategy that makes sense for you on those shorter time frames, sure. But here's the thing. You're going to trade a lot because that changes a lot. The shorter time frame changes a lot. You're going to get shaken out of a lot of good trades because that shorter time frame is what many consider noise. Now, I'm not saying day trading those micro time frames is not profitable. You can absolutely do it. I'm talking to the majority of people right now who don't want to watch every tick that goes up and down, who don't want to watch every quote, who don't want to be like afraid that you can't go to, you have your coffee and you can't go to the bathroom because you're afraid to miss a penny. I'm talking to everybody who doesn't want to do that and wants to place a trade and say, you know what? I think this stock is going up today, and if everything continues, I'm just going to sit back, have my coffee, and I'm going to sell this thing at the close because I think that's where it's going to close today. Those are the people that have another job, don't maybe like myself, who did all that micro trading earlier in our career, and you just take a step back and you say, you know what, this might be a little bit less stressful to pick a side and just let the trade play itself out. I'm not getting on a soapbox. I'm giving you my experience that it is easier to pick the big picture and then look for trades in that direction of the big picture. So we're going to cover a couple of stories. We're going to get into where the futures are trading right now. We're going to take a look at the tape from a market perspective. Hopefully everybody enjoyed the lesson yesterday about candlesticks, by the way. I got some really nice emails about that as well. If you didn't, go to yesterday's best stock picks video, and you'll see it's a big candlestick on the cover. And then we're going to get into Mike B's trade. So I'm excited to watch it because it's kind of fun to go over what somebody else sees based on what we're learning in the video, and I kind of really enjoy that. So this is where we are yesterday. Okay, so yesterday the market, you can clearly see, I'm not going to say a mess because that would kind of make it, that would kind of mean that I'm putting my opinion on the market, and that's not what I mean. What the market did yesterday was very indecisive. So it's smart, if you watch the video yesterday on candlesticks, it's just smart that you either say there was energy or indecision, because it's much easier in that sense that you leave yourself open to pay attention to what's going on and put a very objective analysis on the market, and you say it's obvious or it's not. And you know what? That's actually a really great way to word it. It's obvious or it's not. And here's the thing, like when we look at the SPY ETF over the last few weeks, and we'll take a look at that, there's been a lot of indecision. And that indecision leads to a lot of frustrating trades if you don't notice it. If you do notice it, then as we said, you have to drill down a little deeper and go into your bag of scans and find some opportunities, because the market itself wasn't really helping that much. Although yesterday, we'll get into it in a minute, yesterday the market followed through great. We had scenarios on both sides of the market, which you should always do every day. If this happens, I'm doing this, and this is my more aggressive scenario. If this happens and it goes in this direction, a little less aggressive, and then that means I could go and look for different types of stocks. So this is what we were facing yesterday. This is how the market unfolded yesterday. So what does this mean from a trader perspective? From a trader perspective, trade management means you are better off with limit orders, because the indecision in the market is not allowing for massive follow through, although there was in some stocks, but you can see nothing really had those monstrous moves that we've been watching over the last week or two. So that means limit orders in and out, which means you need to get the price you want. If the stock starts moving away from you, you can go out to the bid or out to the offer if you happen to be long or short, and aggressively take it if your limit order is not getting hit. It also means that you're more likely to be booking profits into momentum as opposed to scaling out of positions and building them. Because remember, we talk about it all the time. There's two types of profitable trade management. There's nothing worse than, I'll just throw a number out there. There's nothing worse than having $1,000 profit and then seeing it go all the way down to, let's say, $200 because you didn't recognize the conditions like I just said. And then the other side of the equation, the second part of trade management, is if you recognize all the conditions are awesome, meaning everything is lining up and you can look at it like that and say, my gosh, everything's in sync. Why would I get out of this thing? So instead of turning $1,000 into 1,000 and get out when it pauses, you recognize those scenarios, it bounces up, pauses, you see everything as your A plus setup and add to the position, and you have those big 1 or 2 home run trades for the week. That's a big part of coaching. I want to say that's not stuff that you can learn in a book. Imagine, actually, that's a pretty interesting thing. Could you imagine trying to teach somebody how to drive all different driving conditions in a book? Could you imagine? Yeah, when there's 2 cars on your left and 1 car on your right, and the light turns yellow and it's raining out, here's what you do. It's impossible. But trading and simulating or reading it in a book. Now, you can absolutely watch as many YouTube videos as you can find. You can absolutely read as many books. You can see in the background, I have hundreds of trading books. It's only a tiny portion. But you'll never learn how to trade unless you trade. Same thing with driving. You have to be in the market. But my point was this. The coaching or mentoring, whatever you want to call it, in real time or 24/7, where you can just type in a question and have it answered, that's the real trading. And we're going to get into Mike's question in a second, because now you're asking questions relative to your perspective on the market. So in other words, if you're in the coaching and you ask a question and somebody else asks a question, you have 2 completely different backgrounds, completely different risk management. You need to ask questions that are relevant to your experience so that you add to your experience. So you start elevating your tape reading skills to get to the point where you're a trader who makes money. So I'm harping on this because this has been a really good week to analyze the tape and recognize how those tape reading scenarios set up trading scenarios. That's my point, because I go from chart reader to tape reader to trader. So tape reading sets up trading opportunities. I'm going to talk about some of the gold stocks today in just a minute, and why I think that they're done. Meaning the short-term move, if I was long those stocks, which we've been calling them as swing trades all week, if I was long those stocks based on what I see on the tape today, I'd be moving up my trailing stop, expecting it to turn around and have some profit taking. Incredibly similar to what we said about the market coming into this week. If you go all the way back to the video from last weekend and the game plan coming into this week, we actually did expect profit taking. So anyway, we're going to go back to a couple of stories for the week. I thought this was interesting. Steve Eisman, one of the guys from The Big Short, the movie The Big Short, in the book by Michael Lewis, he says that, which I think is a really good comment. I'm going to analyze one really good comment and one that I'm like, He said after the 2008 financial crisis, there was a lot of levers put in place to prevent that from happening again to the banks, specifically about liquidity. And they're actually in pretty good shape right now, despite what's going on in the bigger picture and the pandemic going on around the world. So it's pretty interesting. He gives a list of stocks here. I actually agree with him. I think that we got smart about what happened, and I don't think that we're going to allow that to happen again. Again, anything could happen, but if there's a what you might call a marketing thesis, like you're building an argument for a good idea, I actually think this is a good idea. Do with that what you will. That's just the way I feel. This is the story that had everybody, 2 stories actually heading into yesterday, had everybody. Number 1 was the EU stimulus details. Not a monster package that everybody was expecting, but this is the story here. We're going to actually take a look at that. We're going to go into Gilead, and we're going to look at it on a 5-minute chart. This is what happened in case you weren't day trading yesterday or watching the market as the markets unfolded. Gilead, story about Gilead was their drug. Somebody leaked that their drug wasn't working. And the market at that point, everybody was looking to continue buying during the day, because we actually did have a pretty good market up until that day, where all the tape reading that we went over the entire week, the bearish scenario never unfolded. The market went positive for the week, and we started to get a little aggressive on the long side. And we're fully expecting the market to have a nice rally into the close until this story broke middle of the day, which is right around 1 o'clock, if I'm not mistaken. Actually 12:40, even before 1 o'clock. So anyway, we'll go to the market real quick, and you can see how it affected everything. We're actually having a really, really solid market during the middle of the day. In case you don't day trade, normally pull back a little bit, and then all things being equal, you tend to follow through. But you can see during the day now, the E-minis, this is actually where we closed yesterday afternoon. We've actually rallied back, which kind of takes me back into the story the last story, why it's not crazy stocks are rising, even though 26 million people are out of work. It's on Market Watch. You can take a look at it. The guy builds an argument about why some of it's, I don't know, so I'm not going to say I disagree with, but you can read the article yourself. I'll actually post the link below in the video. Here's the point that I want to make about this. And, you know, I'm going to highlight this entire thing, right? Why it's not so crazy. All of his ideas, right? Here's the word that just destroys everybody. This one. Okay. It's his opinion. All right. We can have 1,000 conversations between now and the end of 2020 about why the stock market's doing what it's doing. And the bottom line is, it's very, very difficult to read headline, do all the math, do all of the forward going stuff, and come out with on the other side and say, this is where I think the market's going to be next month. Nobody knows. I'm telling you right now, nobody knows. All that has to happen, there's actually a famous story in one of my commodity trading books about a new broker who said, based on this and based on this and based on this, I think that soybeans, I think it was, is going higher. It might be in the Market Wizards books, actually. I'll confirm that. And meanwhile, his broker, who was a big boss at that time, a very big trader, said, "Oh, I see what you're saying." And he went to the market and shorted and made the thing break through all the support levels he said it was going to hold. And he said, "Just pay attention to what's going on. Don't put your opinion on the market." So what I'm trying to get across here is, I am hopefully teaching you that all of this, the news and all that kind of stuff, is already in the charts. There's hundreds of millions of dollars worth of research out there that banks and governments and hedge funds and everybody like that are using to allocate real money to the market and pushing stocks in the stock market around. Some smart money, some smart businesses. Let's read the tape, follow them, and find a good spot to hop on that ride. It's much, much easier in the long run. And we're not going to outspend them on research. So let's pay attention. I'm not saying not to do it, especially if that's your forte, especially if that's how you look at the market. But what I'm talking about right now is trading. I'm not talking about reading a PE statement or an income statement and where you think the stock is going to be next year. That's not what I'm talking about. I'm talking about reading the tape and paying attention to the next 3 months, the next 6 months, based on where price action is now. And you can take a look at it and even look at prior to the collapse of the market right now, what happened in the market and how easy it was to just now, hopefully you can look at the candles and say, we were well bid in the SPY for 7 weeks in a row. Why didn't I clean up? Some stuff to think about, right? All right, so what we're going to do now is we're going to get into Mike V. Actually, you know what? Let's go to the daily charts and take a look at those gold stocks that I mentioned before. But first, hopefully everybody got a piece of Lilly. This one has been in our list. We were looking at the breakout here, 147.50, and we've actually had a nice slow grinding move higher, and it's still actually in play, but it needs to be above yesterday's high. Next one, Carvana, is one that we've actually been discussing as well. We actually said we were looking for it to pause at this level and then make a run to 112, and it actually has been pausing. As long as it stays above 84, I like the 84 to 112 move. Again, we're talking about swing trades, right? Here are the gold stocks that we mentioned. AU, I'm just going to rattle them off here because I believe that today is going to be a profit-taking day. I'd be looking to move up my trailing stops, WPM. And the last one we're going to take a look at is AEM, also heading up into resistance levels. So again, could they go through those resistance levels? Sure. Netflix did it a couple of weeks ago, maybe early last week, mid last week. But it took 2 years for that to happen. So again, look at how many days closing above the open here and the resistance level that it's had a hard time getting through. Look at that resistance. So I'm calling for the gold stocks to have a higher day and eventually peter themselves out and see a little bit of a turnaround. UNH, also, we got a swing low there in UNH. Swing low is a higher high and higher low. After a low, we're looking for that to retest 300. $15, so don't risk any more than 2 or 3 on your entry, depending on where you're looking to get involved. Zoom is the next one. That's been in everybody's vernacular lately. And I think the biggest thing I want to point out here is something that you'll hear me mentioning all the time: a push and a pause and then a move. This stock is still a trade as long as it's trading above yesterday's high, which is Thursday. Today's Friday. Set your buy stop above that level is what I'd be doing myself. As long as it stays above that level, you stay long and you continue to follow through. The thing you do not want to see in Zoom today is an inside candlestick, because you remember a lot of what we've been talking about is breakouts into inside candlesticks tend to fall back in the other direction. So remember, your trading strategy is, what do I want to see for the tape to be following through? And in this case, you want to continue to see it well bid, which means we need to stay above yesterday's high. Last one is BYND, and then we'll get into Mike B's trades. This is why we watch inside candlesticks. Look at this inside candlestick breakout and also closing at the highs. In case you're new to the channel, inside candlestick breakout's one of my favorite trades because you tend to get trend days the next day. It's a one-day strategy. All bets are off as far as the longer-term trend. If it does trade in the direction of the order flow, great. You can trade a little more aggressive, but BYND actually did bounce. 108 has some resistance, about $10 away. Going to be interesting to see what kind of follow through that we get here. So I want to get into Mike B's trades. He actually has quite a bit of analysis here, which is impressive, Mike. So first one, we're going to go out to the weekly charts. Mike says Facebook well offered 4 months in a row. So let's take a look. Here's the 1 month. So we have well offered here, well offered here. So Mike, we have two months here. Okay. So 2 months of well offered. And now we have an inside candlestick. So I just want to be clear on that. So that is not 4 months of well offered. So well offered is lower lows and lower highs. So in this case here, this is not well offered. This is technically still well bid, but it did close below the open. So that actually foreshadowed the selling, right? So this is well offered. This is well offered into an inside candlestick. So remember what I said at the beginning of the video about the tighter ranges and the mixture of indecision will tend to lead to tighter profit potential, and you manage your trade that way, where you're more be booking profits into momentum as opposed to adding to momentum. But as far as this month is concerned, now we're going to drop down. So Mike, I'm adding to what you typed in there. We're going to drop down. We have a positive month so far. So now we're going to drop down to the weekly. So you can see here the 3 weeks, we actually have a good bullish bullish patterns here. We have 1, 2, 3, 4, 5 well bid weeks in a row with a month that is also trading above the open. So it's not well bid, but from this month's price action, we're trading above the open. So just based on that criteria, Facebook would have been one that you could have, could have been looking to swing trade long, and you have that criteria. Now, what I want to talk about before I get into the rest of what Mike wrote, you know now, if you're watching the video every day, generally speaking, I'm looking for 4 to 6 candlesticks before we start to see profit taking, and that would be what I'd be looking for in Facebook here. So now, well bid candle on consecutive weeks. So Mike, we actually have 1, 2, 3, 4, 5. You wrote down well bid for 3 consecutive weeks. We actually have 5, which is stronger, right? Well bid last 3 days, although yesterday was indecision. Let's take a look at that as well. So actually, we only have 2 well bid days, Mike. Maybe you could say that that was well bid. So we got Monday, Tuesday, Wednesday, Thursday. So these 4 candlesticks here are this week. So we actually had 1 well bid, 2 well bid. So 2 well bid candlesticks here. We do have indecision yesterday. We have a bullish gap above this resistance. Okay, so let's see what else. Looks like room to go to 196. Yes, I agree with that. Maybe a little bit higher. I'd be looking up here, which is 197.24. Was planning tomorrow, enter tomorrow if it opened above today's close, took out yesterday's high, and stayed above that in the opening range. I think that's a good scenario. I actually do like that, and I stick to your criteria, though. If it opens lower, that doesn't meet the criteria, right? 2 concerns. Indecision in the market lately appears to be 50-period SMA has resistance, so let's actually take a look at that. I'm going to drop that one on there, and I'm probably going to have to change the time frame. Let's take a look at that. Oh, I just changed the volume. Sorry. So we already gotten through the 50 on that one there, Mike. So we're actually through that. So we actually broke through resistance. The reason that, well, actually, let me finish it. Secondly, I did something similar today with DGX, was basically in the same position. I got stopped out. So let's take a look at that. DGX. DGX actually formed an inside candlestick. Let's go to the week quickly here. So we had 1, 2, 3, and hit the resistance level. Actually, I've been looking more at this resistance level. And if you watch the videos, you know I usually use the candlesticks, not so much the high and low. I'm looking for the price that's struggling with. So we actually closed at the weekly resistance yesterday in DGX. So let's get back to Facebook. Let's just focus on the Facebook one. I can see you trade. I'm looking for 197.50. Basically, depending on where it opens, you're looking at $12 in profits. The week is still well bid, so 5 well bid weeks in a row. I like to trade long. I would be looking at this at a similar trade. I would have preferred that it closed strong yesterday, but it pulled back with the rest of the market. So we're looking for a higher opening, push higher, and looking for a swing trade into 197 would be the next level. So, Mike, I like your analysis. Just drill down a little bit deeper on the exact what well bid and well offered looks like. But I will say this, the fact that we are now well bid for 5 weeks in a row, I don't believe we're going to get all the way up to that 197 level. So you got 1, 2, 3, 4, 5th week in a row. That's actually pushing it a little bit as far as buying pressure for a certain amount of weeks in a row. So I like the scenario, but because we're in the 5th week, I would not be adding to winning positions. I'd work that order as much as I could, and if it pushed and paused, I wouldn't be adding because we are extended as far as what normally happens. Next, Mike has Zoom, which we just talked about as far as a setup, right? So let's see, it looks like a breakthrough after a 7-day range. Yep, absolutely. Matter of fact, it's also a 20-day breakout. So Mike, train your eyes to pay attention to that as well. 20-day breakouts are big ones. How would you anticipate a huge move like this out of the blue? Well, actually, it's not a huge move out of the blue. If you notice, we've actually been talking about this push and pause, and Mike actually taking it a little bit deeper. It's an inside candlestick breakout. So we have 2 different patterns that led to this breakout. We had a push, a pause. So this pause itself, you would anticipate another move to the upside, and this inside candlestick breakout, which is another move, as I just explained. I forgot what stock we were just looking at, but another one, right? This week, would this be a pullback? Oh, no, I'm sorry, I'm looking at the wrong next one. Good question, the next one, by the way. Profit of 187, looking to enter tomorrow. Should ideally look for confirmation. So, Mike, I just, without actually reading your email before I gave it, Zoom is one of the trades I'm looking at today. I like it above yesterday's high, Thursday's high, looking for follow through. Yesterday had a $14 trading range. I don't believe we're going to travel $14 again in one day. You never know, it could. But the long for me is above yesterday's high, and as long as it stays above yesterday's high, I'm going to trail that one north. mRNA is one that a lot of people are trading right now as well. This one could definitely drive you to drink, but here's the point that I want to get across. The last part of what Mike wrote here is, would this be a pullback or a short opportunity? I would not be shorting it from a bigger picture perspective. So if we go back to what I mentioned at the beginning of the video about looking for swing trades to hop on a ride, whether it's a day trade or a swing trade, to me, this is not a swing trade opportunity because it's clearly, if we're reading the tape, this is buyers are clearly in charge. Now, what you're fighting here, Mike, as far as just clearly, just reading the tape on a stock, you're trading a stock that is a COVID-related play, very similar to what happened with Gilead yesterday. This stock is not exploding for any other reason than because it's in the news right now. So what I'm trying to explain here is, this is not just a trade off the charts. So if you're going to trade mRNA, which is why I've been very sparingly calling it out, even though during the day for advanced day traders, it's a very good stock to get involved with. Because of the volatility, because of the volume, and there's plenty of opportunity. This is not a stock where you're looking at the chart and saying, I think it's doing this because of the charts. This is 100% news play right now, which again, if you're following the video on a regular basis, everybody, there's a massive difference between a news story and clean charts that don't have any news with. The price action is just trading back and forth. So anyway, that's the point that I'm making there, Mike. You also have an inside candlestick breakdown here, but personally, just based on the charts, if we take the news story out of the equation, I'd be looking for a spot to get long, and if it continued to trade lower, I'd just leave it alone. And Mike's final question is there a rule of thumb on where to position the stop loss? Okay, so Mike says, obviously to a level of risk that I'm willing to accept, but is there a standard percentage of the ATR or percentage of the position? I'm going to answer that in kind of three different ways. Is there a rule of thumb for the stop loss? Yes, there is. But I want to answer it in two questions. So I'm actually going to come back to the screen. I'm going to bring Mike's question over. Is there a rule of thumb for the stop loss? Number one is you want to place it in a spot that's not going to get hit. There's really no other like clear definition of that. So in other words, if your stop loss is $20, you don't place the stop loss at 20, which doesn't sound like that's something you would do, Mike. It sounds like you have a pretty good idea. But my point is this: if the stop loss is 20, you do not want to get stopped out on noise. You don't want to get stopped out at 1998. You don't want to get stopped out at 1995. You want to have it at a level that if price gets down there, the idea changed and it's no longer valid. The other side of the equation is learn to work orders, because it's very common for me to have 1,000 shares of something, see the stock pull back, I don't like it anymore, and it reaches down to that area where I might get stopped out. It's very common now, especially though commissions are virtually free right now. In a lot of places they actually are. It's better to get out of the position or scale out of the position and re-enter it than have an absolute stop, assuming you still like the idea. Assuming you still like the idea and assuming you're at your machine trading actively. I'm not talking about somebody who's a dentist or has another job full time and they're not watching it at all. That's not, I'm talking about somebody who's at their machine. So the first one is if you're at your machine, you could trade in and out and around the position where you scale back. If you're not at your machine, have the stop loss at a level that's away from the noise. So again, I'll just use 20 as an example. Put it past 20, where if it gets past 20 by a certain number, again, that's all relative. I'm just using 20 as an example. You're going to get stopped out because the idea changed, not just because you blipped down at 100 shares, triggered, and got you out of the stock. How much should you be risking, you know, percentage and that kind of thing? How far you put it past that level should be dictated by how much you're willing to risk per trade and then have the right share amount down to that level. Is there an ATR percentage? Yes, I've done some algorithmic trading where, let's say for argument's sake, the 5-minute average true range is 20 cents. I've had algorithms running where the 20 cents times a certain percentage of the ATR would stop me out and then re-enter the trade or book a profit a certain percentage of the ATR in the opposite direction. I don't like to use absolutes like that. You can. I don't like when it's discretionary trading where you're manually doing it. So to answer your question in the most generic way with knowing nothing about you, Mike, or whoever is going to watch the video, I always place my stops in an area where I don't think they're going to get hit. And I always trade a right amount of shares or contracts to risk the same dollar amount. So if I have to put it a little further away and I know I'm risking X dollar amount, I have the correct amount of shares. I don't risk more, I risk the same dollar amount and I adjust my share size and my contracts for the stop loss that I want it to be at. If I get stopped out, I want to get stopped out because I got stopped out, not because one bad print went down there, took me out, I come back from lunch and the position takes off without me. And I was taken out of a trade. Somebody in the room yesterday in the coaching actually brought up a really good point. I think it was Tom who mentioned, you know, when Gilead tanked, that's exactly why he put stop losses in the market as soon as he puts his positions on. And that's a good habit to get into, a really good habit to get into. So anyway, I hope I answered everybody's questions today. We're actually going to open up flat this morning as of right now. Some good stories in the news today. I think the gold stocks are reaching a point where they're going to see profit taking in a reversal. And we have a few stocks on the long side, but because the market was so neutral yesterday, we came into the week looking for profit taking this week, which is exactly what we got. Today I'm looking for kind of the same, which I think means we're going to have to work a little bit harder to find some good trades today. As far as swing trades are concerned, I gave you most of the ones I'm looking at. PayPal was a good one for the week as well. Netflix remains a good day trading stock because it's very volatile, has liquidity, and actually not that difficult to read too if you have a good sense of the tape. So thanks so much for joining me at Stocks for Breakfast today. It's Friday, April 24th, 2020. Be safe and let's get profitable today. Have a great weekend, everybody.